Welcome to the program. My name is Marty Schenkman, and I'm joined by a friend and colleague, Jonathan Blotmacher. And we're going to talk about a really critical and common trust planning clause, the tax reimbursement clause. Um, Obviously, all the video clips on Law Easy are for educational purposes only. Don't take any action without being sure that state law is correct and consulting appropriate tax specialists. Jonathan, so tax reimbursement clauses are certainly a really common tool in grantor trusts. You want to give us a quickie introduction to what they are and why they can be so important?
Well, back in the olden days, Marty, probably even before your father was born, people would create grantor trusts even though they didn't want to. And they would be taxed on the income, and they would not want to pay the tax out of their own pockets. And in fact, Nelson Rockefeller was so upset when he was told that he had to pay the tax on capital gains of a trust he created for someone whose daughter actually was disabled, actually got the legislature in New York to put in a provision, which is still there, that if you were required to pay income tax on income imputed to you from a trust, the trust would have to reimburse you for that. Now, New York law doesn't require it anymore, but that was kind of the beginning. And beginning in 1986, when everyone started using grantor trust for estate tax purposes, and lawyers would say, this is great, Marty, because now you get to pay the income taxes that the trust otherwise would have to pay. That means that the trust will grow even faster because you're having tax-free compounding, the most powerful force in the entire financial world, working for you. Well, people said, but suppose they don't want to pay the tax. Can I be reimbursed for that tax out of the trust? Well, the IRS in Revenue Ruling 2004-64 said, okay, you can be reimbursed from the trust, but it can't be such that you're mandated it. It has to be discretionary in the hands of the trustee, and it has to be that under state law, your creditors can't attach the trust because of that possibility of reimbursement, as that would cause estate tax inclusion. So almost every state then went out and passed a rule saying, yes, a trust can be asked to reimburse the grantor, but it won't give any creditor the right to actually attach the assets in the trust because that would cause estate tax inclusion. And that's a very big deal. So everybody now typically, just to protect the client, goes ahead and puts in a provision that says the trustee may, but is not required, to reimburse the grantor for taxes that the grantor has to pay for income imputed under the grantor trust rules to the grantor.
So let me make a couple of comments. I have seen wide ends of the spectrum on this in terms of the use of tax reimbursement clauses. So on one end of the spectrum, I've actually heard people at conferences, and they shouldn't do it, say it's malpractice not to include a tax reimbursement clause. And I don't agree with that. And I think that's just grandstanding to sound, uh, you know, controversial at a presentation. I agree that they should be talked about. I think if a practitioner wants to protect themselves, they should document that they discussed it with the client and what the decision was. I think for clients setting up trusts, they really need to give some thought to it. And the way to really give thought to it, but I don't see nearly enough people do it, is the clients, the people setting up the trust, the settlor, grantor, trustor, should really have a financial advisor create some financial models showing what this may look like. And even if you're going to include a discretionary tax reimbursement clause, then you think you don't have a problem, but it's still good to know. Like, what is it going to look like if I put a family business into this trust to get it out of my estate and or other assets to protect them from creditors, and then I get a massive capital gain down the road? How's that going to look? I think it's helpful for people to understand that regardless of what they do. On the far opposite end of the spectrum, and I actually just had this recently, and I don't really agree with this either, an attorney for a prospective client that I was speaking to uh, stated that she never has ever used a tax reimbursement clause because she's concerned about risks of estate tax inclusion. And I don't think either of the polar extremes are right. The issue that I see with it is I love the flexibility of having it in. I think it's great for clients because it's so hard to anticipate, even with financial modeling, what the tax cost could be. And this way, you have flexibility, which is a great result. The concern is I've seen them misused frequently. I can say affirmatively that the vast majority of cases where I find out that clients, and that kind of tips the hat, have used a tax reimbursement clause, I find out after the fact, often years and years later, that they were making tax reimbursements and they never talked to me as the attorney who drafted it. And the concern I have there is, what are they doing? One of the worst offensive cases I found in terms of estate tax inclusion, an elderly client was having her quarterly income tax estimates paid out of the trust. There was no correlation between the trust income that created a tax burden for her. She was just paying her quarterly income tax out. I think that situation is clearly destroyed the trust. So I've seen them mismanaged. I think it's important, and you may want to comment. To me, what I'd like to see done, if you have a discretionary tax reimbursement clause, I like a real independent trustee. My preference is to name an independent institutional trustee. So there's no question of a wink wink deal where, Uncle Joe is just giving you the money when you want it. It's an institution making a discretionary decision, and not anyone else. That's I think an important safety step if you can do it. The second thing is I like to see an analysis by the accountant based on the terms of the clause in the trust agreement, showing what the trustor, the grantor, the settlor incurred by way of income tax costs as a result of the income of the trust, and then have a reimbursement made for that. And the third thing that I like to see is, I don't like to see this done every year, year in and year out, because then it starts to look like a pattern. I think it should be reserved for, the sale of a business, a big capital gain. I think it should be used with this, consideration to how often it's being done. Jonathan, any comments or thoughts on that?
Well, Marty, I agree with you. In fact, if you really want to shut down an argument that you had a wink wink deal with a trustee, is change trustees. Maybe you start with your brother in there, and then you have a backup trustee who wasn't even aware, wasn't involved with a negotiation, and you can point out that there is this tax reimbursement clause, but it's going to be almost impossible for the IRS to successfully argue that there was an understanding that the trustee would always reimburse the grantor for the taxes. Keeping in mind that it's not in the best interest of the beneficiaries for that to occur. So the trustee really needs to weigh the decision, as you said, Marty, and figure out what's really going on. And of course, we have down, what about turning off grantor trust status? Well, that's maybe not in the best interest of the beneficiaries because, again, the grantor is going to be paying the income tax on trust income. If you turn off grantor trust status, that will no longer happen, and the trust will not grow income tax free. Now, you can try to anticipate all that in drafting, and I think you should. But dealing with tax reimbursement clauses is not easy to really implement and follow through, especially for a large trust.
Yeah, we're gonna do another session on turning off grantor trust status, because that's a really important concept to address as well. Just one last quick comment. I think that one of the most important aspects of a successful tax reimbursement clause is to have those involved with the trust have a meeting with the planning team, the attorney, the accountant, the trust officer, the people involved in these decisions in an administration of the trust on a regular basis, because then you can really talk through these issues and make strategic decisions before something is done, and document things in a good light. The concern I have is, too often I, as the attorney for a trust, don't hear anything until years after the fact, and then if things were not handled the way I would suggest they be handled, it's too late. We're going to have to wrap up because we're out of time. Thank you for joining us. Remember, all the video clips on Law Easier for educational purposes only. Tax reimbursement clauses, really important clause. Be certain that you talk to your entire advisory team when you're planning the trust and during the administration of the trust. Thank you for joining us.